We're now going to be talking about getting investor ready. What does that actually mean? I'm going to hand you over now to Nick, who's going to host this session, and we'll kick off.
Excellent. Can everyone hear me okay? Am I on? Yeah? Cool. Thank you. Hello, everyone. Welcome to the Investor Preparedness session. Delighted to have you all here. Also online, thank you very much for joining us today. Hopefully this will be a very interactive and practical session. I'm really keen, we have an amazing group of panelists to give you some real practical know-how to take away with you today. And yes, hopefully the way that we're going to structure the discussion today is we're going to tranche it into three pieces. The initial piece will be all around how to prepare for your campaign to get funding. The second section will be around how you actually go about reaching out to investors and different types of investors. And the third piece will be focused on closing the deal. So that's all around the final piece of the puzzle, if you like. After each section, we'll have a Q&A, both from the online audience and hopefully very much from you as well. Please ask away, anything that you wish. Online audience, you can of course ask questions through the platform on the Q&A session, and then we will be fed those questions after each section. Right, without further ado, I'd like to introduce my panelists. In fact, I'm going to ask them to introduce themselves. And perhaps starting with you.
Sure. Hi, everyone. My name is Alan. A little bit background about myself and how I got to where we are today. I graduated from university in 2017. Shortly thereafter, started my own company within the FMCG space in the UK. With that exercise, I was kind of quite happy with over the course of 2 years. Finished my learning curve on it, didn't get anything more out of it, so moved to Berlin and joined Entrepreneur First to work on their office there. Primarily working on the form side of the program, so helping people find co-founders, companies like this. This is proven one, moving on to other co-founders, and eventually trying to create a company and a team that EF wants to invest in at the investment committee. Through them, I did do a bit of work with getting the team's investors ready, that was more for the launch side of the program. I then joined Landscape at the beginning of 2021 as the head of growth. At the time, Landscape was the first full-time hire. I joined founder Joe to work on the platform, which was at the time primarily a review platform for founders, rating review investors they're interacting with, good, bad, mediocre experiences. Since then, we very much still focus on that as our growth side, but we are still moving towards making the platform more of a source of founder-friendly tools to help fundraise, do their due diligence, find deal flow, and connect with other investors and other founders. So we're launching various products to help founders in the fundraising process. And likewise, on the investor side, helping investors improve their fundraising processes too. It says head of growth, still very much head of growth, moving more towards an operations side, but still working very much alongside the team.
Brilliant, thank you. Harrison.
Yeah, Harrison, I'm the investment director at Trails Tube. We're an early stage investment firm based here in London. We do things globally. We've got now 25 portfolio companies across B2B, SaaS, and fintech, and we occasionally branch out to other things too. Been around for 3 years, and we're actively deploying now and in the future. So if you have an interesting idea, please let us know. My background's on the fintech side. Spent a year at Zinja, Australia's first neobank. We scaled from 25 employees through to 125, raised 120 million AUD, and had a pretty mighty device in there. Some other issues afterwards, which you probably read about in the news if you care to know or are interested. Came back to the UK and joined IBM, was in their financial services division for just under 2.5 years, selling to tier 1 banks, financial institutions, I guess you could say so the other side of the financial services industry before joining Charles Tube a year ago. We also run a fintech syndicate on the side. We've done 6 deals this year to our account.
Brilliant, thank you.
Morning, everyone. Mic working okay?
I don't think so, can you?
Better?
Yes.
That's good.
Yeah.
Does it stay? Better?
Yes.
Okay, excellent. Hi, good morning, everyone. So Aldo De Leonibus, I am the CEO and co-founder of a company called Inventia. So at Inventia, we support a broad range of businesses in accelerating their growth, both through supporting with innovation and with the different elements of fundraise. I'm also one of the Scale-Up directors for Innovate UK Edge, that you've probably heard about the Scale-Up program, the Innovate UK Scale-Up program in the session earlier. Aside from having started Inventia, I'm also an investor. I have a portfolio of about 10 different businesses that span anything from HR, accountancy, commercial residential property, business support services, and IT development as well. In terms of Inventia, we work across a broad range of different technology sectors, anything from clean tech, healthcare, engineering, fintech, etc. And one of the things that we do with Inventia is support with the fundraiser. And we've helped over the years our clients to raise over 160 million.
Excellent. So as you can see, we have a really broad range of expertise between the panelists. I'm really keen for you to test them on their knowledge and ask difficult questions. Just a little bit about myself, Nic Lenz. I'm a fintech advisor, help early stage tech companies predominantly with raising funding. So this is very much close to my heart. I also have a couple of non-exec positions and board positions that I do in my spare time. Perhaps a quick question for the audience, just to get a sense of where people are at, both online and in person. Can I just get a quick show of hands in terms of where your company or where your project is currently at? Is anyone actually either in the process of or looking to fundraise in the near term? Just a show of hands. Brilliant. Okay, so it's, I would say, well over half in the audience. So hopefully this will be really relevant to you. Starting with investor preparation. So I want to zoom right out to start with. What is the time frame that I, as a founder, need to set aside when I'm thinking about fundraising? And also the sequencing of that process. I have come across many founders who think, okay, I probably need some money, and actually, preferably by the end of the month. And that's quite tricky. Yes, it can be done, but I would advise you to perhaps take a little bit longer. But and perhaps starting with you in terms of timing and how you think around.
So I always think it's always going to be far longer than you can expect. Founders have always got a certain amount of time, it tends to be much longer than that. And obviously it will depend on who you're raising from. So I think a round that's heavily led by angels is going to be much quicker than a round that's led by VCs. I would say on average, Doc sent some research that on average, a typical round takes about 12.5 weeks. The shortest round can be anywhere from 6 weeks. Longest round they found was a 40-week round. So setting aside more time than you think is really the best strategy. It's really bad to run out of runway around any funds you have and not reach your milestone because you run out of your cash flow. So I'd say setting more time aside than you think it's going to take is probably the best approach. On average, I'd say put 6 months aside. That's probably the best.
Yeah, I think that sounds very reasonable. In terms of, so if you have your calendar in front of you, you're a founder, co-founder, how do you think around resourcing that whole process? Because clearly, you have a business to run as well as raising funding, which is incredibly hard. I've been there firsthand. Harrison, do you have any thoughts or tips around how do you allocate resource and make sure that things keep running?
Sure. I think it's good to touch on in Alan's point as well in terms of runway and timing. There's two considerations. There's the actual time it takes to raise the round and the negotiating power as you get to running out of money, the time constraint and the kind of leverage you have in conversations. drops off rapidly. Going to market with one month of runway is both tight on timing and tight on, they know you need the money, and that, knocks down your negotiating power, especially in the VC market. So
Yeah.
we always recommend, on that front, being both proactive in terms of timing and planning, but also in terms of how much runway will that have, and then raising enough that you then keep the next round out far enough, and not constantly in a cycle of raise, because you want to keep enough runway to run the business, but you also want to be, focusing on your core business too.
Yeah.
And that, is a balance you need to strike, and that comes into resourcing. If you're constantly raising, someone is constantly out of the business to be focusing on fundraising. Whether important or not important, that's not the core focus of what you're going to do. So on the resourcing side, if you've got multiple founders, we always say, have one founder completely spearhead that process, start to finish, bring the other founders in for certain calls, but in general, ultimately, it should be a spearhead process, and the other founders work on the rest. On the broader team side, so some investors, especially VCs, if we get into later DD, they're going to want to bring in, heads of product or heads of finance to maybe talk about that area, CTO talk about roadmap, but we would always try to shield those resources. One of the founders take first call, take the intro, get as far as you can into the process, ultimately then bringing people as and when you need them. But in terms of who else, is kind of key, financial side, the CFO for that part of the journey, or kind of head of finance, they are important in terms of capital planning and early in the conversations in terms of valuation, etc. But I'd say in terms of resources, at the early stage, there's no need for more than one founder, typically CEO, but we've seen it done differently. And as you move through the round, the owners become much greater. In the later rounds, you start to see advisors. At Series B and onwards, you tend to see investment bankers coming in, they then spearhead the process, but typically early stage, seed, pre-seed, single founder lead, and then bring in the other heads of teams as well.
I think that one of the points you mentioned is a really relevant one in terms of when you're looking to raise, think about where that raise will get you and your company, right? So if you're going to raise X, what milestones will that allow you to achieve? And to Harrison's point, what does that then mean when you're ready for your next round, right? So what milestones can you tick off with this raise? And what does that mean in terms of when you need to be raising next? And do those milestones then make your next raise, more attractive at a higher valuation, et cetera, et cetera? I think that's a really valid point. And I just want to build on that because it's an incredibly time-consuming process. In terms of documentation and what investors need to have as a bare minimum, and how do you go about putting that together? Just some thoughts on that, Aldo. I know you've been through many of these processes.
Yes, no, absolutely, Nick. And in terms of documentation, is also very much linked with the timing. So it's important to have all of the information ready when you're starting. We come across often companies that have not prepared all the information before starting. So of course, when they start, it increases some time. In terms of documentation, for us, the most important that we look for when starting a fundraising round is it's very important to have information about the product. If possible, it depends a lot on the industry and the product, but to have some sort of a proof of concept that is available. Then information, probably even more important, from the market. So buy-in from the market, input from the market, be able to evidence interest from the market, and if possible, even be able to show that you have worked collaboratively with the market to develop something that there is an interest, that it's addressing a particular challenge. Then in terms of the more specifics, of course, a pitch deck, then financial projections, a good set of the financial projections, an investment memorandum, which is slightly more expanded on the pitch deck, and then a business plan with more details. Often if the discussion with investors progresses well, some of the investors will want to see the full business plan.
Yeah. I want to pick up on one particular point, which I know is a real sticking point for many founders. Is, okay, you have this fantastic idea or concept, maybe you've already developed it, you've got an MVP, but you don't have many proof points yet, right? You don't have much proof of product market fit. What are some of the things that you can think about in terms of how do you get those proof points, or are there some hacks perhaps that we can suggest as to, you know, from a very early stage where it's just beyond concept and maybe MVP, it's definitely one of the most common questions that I get is, okay, I have this amazing thing, it's going to be brilliant, but I just haven't got enough traction to demonstrate to potential investors that this thing is actually going to work. Who would like to have a first go at that?
Practically, or from anecdotal experience, very much how to get started was very simple, no app, budget like £300. Build a no app, just saw reviews come in, proof of concept was coming from that. A waiting list to offer our newsletter. People, investors showing interest, wanted to sign up to be verified partners on our platform. So a lot of this was done very low budget, very low effort to show investors that there was this traction, potential traction there. We had proof of concept. And simple things like that, where you can just show that there's a lot of interest, and if you were to take to the next stage, you grow quite quickly and quite easy to come by.
Yeah, I think there's two things in there that we always pick up on the B2B side, B2C side purely, in terms of sign-ups, wait lists, you know, something that perceives interest, as you mentioned, but it's a tangible number, which you can give a metric, you know, you can give out growing monthly, you know, and there's always an argument that how valuable are those, but it's something that can't be argued with in terms of data to back up, you know, a story. And then the flip side of that is on the B2C side, give the person something tangible to look at and play with to some extent. You know, there's a childish element to being able to hold something.
Yeah.
That is quite powerful in terms of, you know, a pitch deck, a vision, a story, and an app that you can download and have a quick go with, or a website you can mess about with is something that makes it seem a lot more real and a lot closer to being a fruitful vision. On the B2B side, it is a touch harder to show that traction. You know, if you sell it to SMEs, then it's one thing. But if you aim to sell it to enterprise, you know, your sales cycle is huge. You can't do that for you for tomorrow. So again, you're looking at, you know, a simple proof of concept, whether that's a demo, is a typical one we often see. You know, the starting of building out a funnel, you know, and then comps and that style of things is kind of where we see, you know, if you're going to build a messaging platform, you'd say show how well Slack's doing, etc. And you can argue if that's saturated or not, but you know, you'd show something of traction from others, and then typically how your concept is their better product experience wise. But the B2B side is definitely harder than the B2C side.
Yeah, I would say that just picking up on Harrison's point there, because I think a really valuable one is how can you make your proposition become more tangible, alive? How can you paint that picture to someone who's never heard of you before? You're living and breathing your dream, but to transpose that to someone who has not been there, and you need to get them excited. I think Harrison's point around, you know, making that proposition live for a product demo, or just, you know, how you paint that picture is really important. And the other aspect, coming back to Adam's point around, you know, there are some really simple ways that you can demonstrate some product market fit, or get some, you know, early traction, or build a wait list. You know, all these things. If you can have enough of those, that starts to build a picture. All of a sudden, you're de-risking your proposition to your investor base. So that's quite useful. Sorry.
Oh, no problem. Very good points that the work for all of the products and technologies. For a certain type of products and technologies, another strategy that we've seen that works really well to have input from the market is that there is a lot of grant funding available, for example, from Innovate UK to fund collaborative projects. So you can build a collaborative project together with organizations in the industry, with your potential customers. And you can obtain all of the validation data, for example, as part of the collaborative project, so that at the end of the project, you have all the information you can then take to investors and take to market to accelerate the development and the fundraising and the penetration.
Great points. And also the mere fact that you have had grant funding means you've gone through that process, you've been through a certain amount of due diligence. Again, really, really useful in those conversations. I'm conscious of time. Q&A. Can anyone in the audience, obviously, if there are any questions on the online channels, please ask away.
What's the reasonable number of users to have on the wait list?
So the question is, what's a reasonable number of users to have on a wait list?
I think that's the magic question. It really ranges, you know. If you're out to raise in the hundreds of thousands for angels, I've seen wait lists as short as a few hundred into sort of the 1,000, 2,000. You know, that's kind of the typical range I'd say, 1 to 5,000. And if you're getting more than that, you know, then you're talking probably the hottest deal of the year, in the 20, 30, 40,000 range. But they're few and far between. But I've seen in the 100 range where what probably happened is they've sent it to every friend and family they know, and they've gone signed to this, and they've gone okay, you know, and you can buy a bit later, and it works out okay. But you know, I'd say if you can get into the 1,000s and the low 1,000s, you start to show real traction and interest, and that typically comes from sort of activating social media channels and that sort of thing, and getting following, which is naturally harder. That's something to really show, but you know, it's all about trying to build the concept that people are already interested in, the hype, if you want to call it that, because there's something in human nature where people follow, you know, what is perceived to be popular and important, and that kind of self-perpetuates in terms of.
I think also an important consideration in that is what's your business model, right? If you're selling something at, you know, 10 quid a month, then obviously the number of users that you need to support your validation of your business model is quite important versus, you know, if you're selling an enterprise package for 100 grand a month. So just keep that in mind in terms of perspective. Yes, lady, right about.
Hi, so in terms of like proof of concepts and, you know, trying to test things out, how really should your brand be? Or should you just go out there with a working brand and not worry about it damaging your future perception? So some things might change. You know, doing things on these no-code apps and on Wix, and doing it yourself. So, like, at what stage should you be happy and ready to go out with something? That damaging.
Okay, so around timing of when you go out with regards to your venture may not be fully fledged, some things may change.
It's a great question. I have a mentor who is just brand. That's what people like. People buy his brand, they buy the product. And there's been a lot of research that shows that big kind of emails like Airbnb, Facebook, they spend all of their marketing budget on non-brand stuff, and then 5 years into their growth, it's all brand, and that's why the growth starts kicking off. So I think at the early stage, brand is less important, but it shouldn't be ignored. As soon as you start getting that initial traction, you're getting that proof of concept, you need to start dedicating your time towards brand, because consumers want to see that consistency, customers want to see consistency from start to finish. And there's nothing wrong if brand changes. I think being honest and transparent about it also kind of tie that into the brand landscape. We're very honest about being transparent and with the customers and the users being part of our journey and saying, yeah, we do change. This is what we were like at the beginning. We learn, we get feedback, now we know this. So definitely going to the brand as people buy into it. I buy into brands every day because the value of the things that they communicate to me. At the initial stage, as I said before, I think if the product is sound, and that's what people are buying into, but once they're hooked on the product, they're going to stay with the brand.
I think a really good point there in terms of both investors but also customers should understand that if you're at a very early stage, you're probably going to evolve over time, right? So there is an element of evolution of your project over time. So don't be too scared to go out, you know, if your concept isn't fully developed. It will change for sure over time.
And a quick point to add to this, it's a really good question. In terms of timing, there is also the concept of a minimum viable product. So we come across very often inventors, entrepreneurs that wanted to develop everything, but often it's better to develop something that shows how things work, so a minimum viable product, and that's often the right time to start to go to market and show to the market what you have, so that you can capture the feedback from the market into further developments and to develop something that is market ready.
Rather than going too wide too early. Yeah. Are there any questions online? I'm conscious I don't want to.
No, we've got a few minutes. It's really important. So, it's what is, if there was one thing that you see from investment debt that holds investment back, what is it?
That's a great question. I have my own views, but I'll.
Yeah, I see a fair few, so I can probably give a personal opinion. It's market missizing is now my biggest growing, issue, and that's not necessarily something you may expect to hear, but it's, we talk about TAM and then serviceable market, so total addressable market, scaling that down to like serviceable market, and that's going to be direct current focus, and when you see TAMs in the 20 trillion and more, you start thinking, well, it's not, it's a case of the largest company in the world is north of 2 trillion, so you're talking a target market of 20, how's that going to work ultimately? And there's always a balance of, to be a visionary founder, you need a vision and you need, belief in the longer term, but there's also a realism and a balance. And when you scale 20 trillion down to serviceable, it's still going to be extremely large, which is just simply unrealistic, and often it just shows a lack of maybe real understanding of what you're actually playing in, which is, that's not our area, that's ultimately the founders.
On that, just to carry out another step, because there's desk-based research, so when I go, oh, I've done a bit here, it's actually, we could say a billion, but it's a million, for example. Is there any data sources which would really impress an investor? So YouGov, data panels, surveys, is there anything that would really go, you've got to make your mark there, I can see it moving forward.
For me, a quick point on that, without answering your question, is rather than just the total size of the market, is the addressable market, which goes into the business model. And so we have to prove to the investor, okay, that's the market, but I can't go for 100% of the market, I can only go for 3% of the market in the first year, and that's how I'm going to do it. So it's backing up the figures to evidence exactly that.
And for me, also a really important one, if you do look at your market sizes and you get to the serviceable, obtainable market, is what underlines your foundations for that number, right? What are some of the assumptions you're building into that? And if I can get comfortable with that, I'm fine. It can be a huge number or it can be a smaller number, but as long as I understand how you've built that up, that's it.
So it's more of the formula than
an absolute number for me.
Regulated data source. You told me a story, which is going down.
Yeah, you talked about top down and bottom up. Yeah. They're kind of the two analysis methods people tend to go through. Top down, you're talking, I can take 3% of this large market. You go size down, and on the other way you go, if I'm selling my product for £10, if I acquire this many users, which I'm on track to from XYZ previous metric, and you do the maths up, and you go, well, I can get to this size in 5, 10 minutes, whatever the time scale is. They're the two analysis methods. We'd be more intrigued to hear the rationale, the assumptions behind that process than necessarily if you've got the data from, a primary research survey or the internet.
The source is important, but it's easy to find the right reputable sources on the internet, generally speaking. Regarding the first point, something I wanted to mention just very quickly, it's also important that one of the reasons why we see investments fail, it's because there is a mismatch between the proposition and the investor. So as part of your research, you should also look into the investor and what to invest in, what they're interested in. So it's understand the three-dimensionality of the investment. Of the investor.
Because you can often set the whole story mapping. You can do something right at that first moment with what the actual audience is saying and deciding the rest of the magic. It's
marketing becomes first. It's the first hurdle, right?
Naturally.
Anything else? There's loads of questions online. I think we'll field those out there.
Okay.
I think we've probably got one more in the room.
Yes, please go ahead, lady.
Yes, thank you for the information. If you were an earlier stage startup, what you would do? To get an injection of capital in that terms.
In terms of what, sorry, if I'm an early stage startup?
If they need an injection of capital,
Yes.
being an early stage startup, what do you do?
Yeah, what would you do?
I think I'd probably start with a deck on the idea and the concept. If I'm talking from scratch here, I'm setting off with a deck and an idea and a co-founder. Ideally, I'd get to the most simple proof of concept you could make in terms of wireframe, whatever it may be. And then I'd probably attend every business angel group, forum, pitch day, and evening I could, and I'd start with the angel route. They tend to be, I'd also probably work on the HMRC side and try and get SEIS or ES, and I'd take my SEIS and ES advanced assurance to every business angel network I could, because they both give you capital, tend to be more risk on in terms of what they're willing to invest in. They're going to be more willing to invest in a super early stage company, and they can then bring the connections that brings in institutional and more capital down the line. But the business angel networks, you sort of killing as many birds as you can with one stone. You might be one pitch to 50 business angels at Henley Business Angels Network, a company I just did that a few weeks ago. So I'd say that's a good place to start for sure.
I think if you really at a stage where you need to ask yourself, do you really need capital? Is it essential? If so, why? Is it growth? Is it your team hiring? Is it to develop an MVP? And if it is essential, have you exploited and looked at all of the funding options? I think when it comes to pre-seed seed, your institutional investment for VC should be like a last resort, which you bring at the very end. One, because they're not really going to just invest in such an early stage startup anyway. You much better to go to angels. You might not want institutional VC just to kind of be a really investor. It's such a great for your future prospects again. Make sure you get deals, but I think looking at all the different other options, be it crowdfunding, be it grants, be it back loans, be it revenue-based investment, should be your priority, and anything institutional VC should be your very last resort. And if you are going to go down that route, a clear outline of what you've done before and how to get to the next milestone.
Yeah, I think the last point is really, really crucial. Transparency around where you're going to be investing the money is really key, right? Because you're asking someone potentially who doesn't know you, doesn't know the company, you're asking them to part with their money. Okay, so how is that going to be spent? Give me some transparency and why, right? So if you're raising £1 million and you're telling me 80% is going to go in marketing, that's potentially red flag for me, because I want to know, okay, well, why is that marketing piece so big, and what is that actually going to do to your business? So just be kind of pragmatic around that and very clear in terms of the expectation. Do we have a few more minutes?
I think we're up to time.
Yeah.
I don't know. Oh, there's one more.
Yeah.
It's like,
There is someone just behind that.
Two more.
Two
Yes, the lady.
Yes, so my question was that we talked about that when we raise the funds, obviously there is a deliverable and there is an inflection point, so we need to deliver something. So obviously the transparency is quite important. But what happens, obviously things can go wrong and you don't really want to run out of cash, because then you're in a situation, you're very vulnerable and the valuation kind of, that could probably affect the valuation. So what would you suggest to make sure that, basically what I want to know is the red flags, that how do I know that I'm not running out of cash and I'm basically on track?
Okay, great. Can I take the next question and we'll answer them in the gentleman?
So we're actively talking to the investors, and we've got a little bit of emotional attachment to the tech that we're creating. So I'm just wondering, when you go into a conversation at pre-seed, seed level, how much equity do you measure in terms of wanting to give away, in terms of what the investor expects, and what does that look like? Is there a guideline in terms of the equity giveaway?
Okay.
How do you negotiate that? Because that is probably our most great area when it comes to this.
Two great questions. So one around milestones and how do you, when you hit the roadblock or you go slightly off track, how do you deal with that to make sure you don't run out of money? And the second one around valuation, early stage, how much equity do you give away? Are there some rough benchmarks? Who wants to go first?
I think just to answer the second question, I think rough ballpark, 10 to 20%, you should expect to give away depending on the investors you work with. It will depend as well about how hot tech is, how many investors are interested. That's all going to kind of come into play, how much trying to raise. And then to answer the first question, I think the best thing you can do is just really have a good idea of what your cash flow is going to look like and how long it's going to be. And don't be afraid of asking investors for their advice as well. They're more than happy to give you input about, hey, actually, we think you should raise this and not that because of X, Y, and Z. I don't really have any tips about what to do when you could be this masters and you run out of cash, and you also have investors and masters
Very briefly.
Yeah, sure. I guess on the cash point, on the KPIs, I'd say do the maths on what you think you need to raise and add half again, if not double, because it's just not worth being in that situation in terms of the money constraints, and ultimately that's kind of the added pressure that ultimately investors shouldn't want to put on either. But likewise, there's an expectation and understanding from investors, that their KPIs, their targets, but they're not always hit. People don't always hit targets, and we as investors would understand that, whether that be, okay, we need more money. Is this worth putting more money into? Is this something that's going to work? Is it we're not quite there on market timing, we're a bit early, and then you have that open dialogue in a good kind of investor-founder relationship. And likewise, it may be, we're a little bit off, we need to pivot a little bit this way, but that way, that might need more cash, that might not need more cash. But let's say it's open the dialogue early, understand that their KPIs are not always hit, but also be willing to pivot, change slightly too. If it's not quite right, it's not quite right. And on the other point, it's
just to reiterate, the communication point with your shareholder base is so important, because that way you can preempt. The investors already know that there's some things happening, and some may not be, exactly where you want to be. But if you have that conversation early on, it's much easier conversation to then sit down with us and say, actually, we're doing great on these and these parts, but actually we're not hitting the mark there. We may need more money or whatever. It just eases the conversation. That's really key. So,
yes.
And in terms of valuation, we can have a whole day discussion around valuation, but there are plenty of stats out there. Pre-seed and seed rounds, you're going to give away between 10 and 25% of your business, ballpark. And then there are variations around that, but that's a good starting metric. Look at some of the comps in your space. Yeah, how much have they raised? What valuation? But valuation is a whole different discussion again.
Good news is that we're running, as I said earlier, investment surgery after lunch. So if there's any last questions, and so discuss lunch, do the break, and we'll bring that back just after lunch.
I'm moderating that one. So
yes,
I can pick up any questions on that one.
Well, it's good to hear the rest. Jed, fantastic. So looking forward to it. Really awesome. Thank you so much.
Thank you very much.